as an investor, we make money when we can play a cycle for a long period of time. And what makes this cycle different is this fear about energy transition. It's keeping a lid on supply in a way that I haven't seen before.
Well, I've been really excited to bring you onto the show because you've been discussing many of these interesting topics and talking a lot about where things are heading with regards to the energy space. And you have extensive experience in the investment industry, especially in energy. And I really wanted to bring you on to get an update on where we stand today and your views on the market. So before we talk about today's market, Arvind, how about we start by looking at the big picture and explaining how we got to where we are today to help set the stage for the discussion.
Well, I could go back a long time, but, my career spans over 30 years of analyzing and then investing for the last, 22 years or so, investing in the energy space. So energy and I guess mining, but energy is the broader, longer time horizon. And I would say that, the energy has, when I got into the business in the 86, 87 time period, oil had crashed to $10 a barrel. There was too much supply. And for most of my career, the energy companies responded, have money, we'll spend. So it was like money in, money out. How fast can we grow? And it was always trying to fight an uphill battle in many parts of, certainly in America, but in many parts of the world, going out for exploration risk and everything else. And then when I got to the investment side so there were mini cycles from when I got into the business. I missed the entire 70s. I wasn't in the business. I was too young. But in the, late 80s and 90s, there were mini cycles. Things got good for a while and then they rolled over. And then what really, I was lucky in my timing, what really happened in the 2000s is the emergence of China. And at this emergence of China happened at the same time as we started worrying about peak oil. So what you had is a confluence of very strong demand growth from emerging markets led by China, which was kind of the first major cycle that we've had since the 70s, where you had a sustained cycle for several years. At the same time, we were worrying about running out of energy. And I got into metals investing, kind of a couple of years after starting an energy investment portfolio. And they were similar drivers. China, emerging markets were the drivers of this boom. So that was a great cycle that, unfortunately ended more or less with the global financial crisis in 2008. I left SAC where I started my career, and I started my own fund and had a lot of success in attracting investors, as is unfortunately classic. At the top of the bull market in 2007, I was able to attract a lot of money and launched Geosphere, and we got off to a flying start, did relatively well in 2008. But then the decade of the 2010s hit. And in the decade of the 2010s, what you had is a cycle that, after the global financial crisis, demand recovered. Demand wasn't quite as go-go as the China bull market era, but it was still very solid. But what changed is, certainly on the energy side, is shale oil. And shale oil created too much supply with no capital discipline. And China itself also, because it was a much more debt-fueled rally, wasn't quite as materials heavy, and the mining companies overinvested. So you had both sides of the business. During the 2010s, you had negative returns if you invested in mining stocks or if you invested in energy stocks. Obviously, 2010s, unlike the 2000s, you had no returns in NASDAQ from 2000 to 2008, and you had great returns in energy and metals and mining. And then you had the second cycle where it was the exact opposite. You had great returns in NASDAQ, and S&P was reasonably good, and you had negative returns in energy and metals and mining. So those were two major cycles that I saw as an investor. And, we started this new fund. I shut down my earlier fund at the end of 2018, and we started this new fund because I saw a new cycle emerging, and we've named it Sensible Energy Transition because we think the driver of this new cycle, every cycle is different, but there are echoes of previous cycles in every cycle. And this cycle that we see emerging is clearly the dominant theme is energy transition and how quickly that's going to happen and what effect that has on supply and demand.
In studying investing, one of the really interesting things you sort of highlighted is these pendulum swings, these big swings that people can find themselves in and sort of get caught up in. And it's quite well known that energy is cyclical, but markets overall all are cyclical as well. I think a lot of people sort of forget that an S&P 500 or a NASDAQ can have a great decade followed by a subpar decade, and those riding the wave on these cycles, look like geniuses in a bull market before it inevitably turns the other way. I was curious if you could talk more about why energy markets in particular are so cyclical, and maybe touch more on why you believe this cycle. What are some of the most important things that make it different than previous cycles?
Well, I would say that what makes cyclical industries cyclical is that both supply and demand tend to have some cyclical aspects. But I think demand cyclicality is more economically not very different than the rest of the economy. Supply is what really makes the cyclicality long lasting or deep. And it is a question of how long it takes for supply to respond. And typically what happens in most cyclical industries is that, demand is going up, everybody gets excited, supply comes on, and supply kind of peaks just at the time when demand is starting to come off because everybody counting on the demand story growing to the sky. And then you get a double whammy of falling demand or not much rising demand and all this oversupply, which takes a long time to work off. So the cyclicality on the demand is more modest. The cyclicality on the supply takes a longer time to come on and takes a lot longer time to come off. So that's what makes the cycles pretty extended in terms of the energy business. And on mining is not that different. What made energy cycles shorter, and we had very mini cycles in the 2010s, is shale oil came on very quickly. And shale oil, on and off, and in 2014, 15, 16, when oil prices corrected, supply came off. We had one good year, and then shale came rushing back, and it ended again. So what caused me to give up on this cycle is the dominance of shale and its quick on and off, and that as an investor we make money when we can play a cycle for a long period of time. And what makes this cycle different is this fear about energy transition, which in my opinion is keeping supply, it's not my opinion, but everybody knows it's keeping a lid on supply in a way that I haven't seen before. So, I'll give you an example. When you look at the offshore drilling rigs needed for offshore oil production, new exploration, a new rig costs, 700, 800, 900 million it'll take to build a new rig. It'll take 3 years to build a new rig, and then it's going to need a 20-year life cycle to pay back. So if you're ordering a new rig in 24, it's going to come on in 27, and you're going to have to look at the demand for it through 2047. And if everybody is now debating whether oil demand is going to peak in 2028 or 2030, I happen to think it's going to be longer, but even I'm not willing to bet on 2047, right? So the reality is that there's no investment there. Now, if you look at the oil side, shale is still there. What caused oil prices to come off last year was shale surprise on the upside. But what we are seeing now as the rig count has come off on that is that we may be in the 8th inning of the shale boom. And the rest of the world, there are pockets of growth. And yes, OPEC has surplus capacity, but structurally, nobody's investing in a meaningful way in long-dated oil. There are a few exceptions, but overall, long-dated new oil exploration, not just rigs, but long-dated new oil exploration, oil companies are reluctant to make long-term bets. So even when you had Exxon and Chevron announced recent acquisitions, in the case of Chevron, it's a shale play where they're hoping for quick payback. I'm sorry, in the case of Exxon, when they're buying Pioneer. In the case of Chevron, they are buying into Guyana, which is a slightly longer dated play, but the success of full discoveries have already been made, and it's more about hooking up existing wells as well as doing development drilling to get the other wells on, over the next 3, 4, 5 years. And the production will last for a while, but it's not making a long-term exploration bet with a long payoff. And that's what we're missing is new greenfield, elephant hunting, as we used to call it. And so that's what keeps a lid on supply, and that's what makes the cycle long. And, let me not forget to mention that one of the energy sources, there are two other energy sources that people don't include in energy, one of which is coal. It's a four-letter word. It's terrible, according to every, CO2 output person. But the reality is the emerging market, 65% of world's of the power generation or more of India and China comes from coal, and other poorer countries in Africa, South Asia, Southeast Asia, and that coal demand still remains the cheapest form of energy, and nobody's investing in new coal capacity except maybe the national oil company in India and maybe the Chinese, and so therefore that's going to be a tight supply market, even if we want it to go away. But the reality is cheap energy for the poorest people in the world is still something that they aspire to, and therefore that's going to remain. And then there's uranium, and we want green energy, and uranium and nuclear is a new green source. And again, there's a long cycle for investing in that. So energy is very often narrowly looked at as oil and gas, but there are other sources of energy, one of which is terrible from a CO2 standpoint, and one of which is very green from a CO2 standpoint, nuclear and coal. And both are going to have, challenges. One on the supply side, while the demand remains stable, supply is shrinking, and the other, it's going to take a long time to turn supply on.
Yeah, I also find it really interesting how there's all these moving forces where these dynamics and interplays within all these different energy markets. And, I'm sure being an investor in this space is just a never-ending journey of diving into all this data and seeing how, coal is going to affect natural gas, is going to affect oil and all that. And I wanted to talk more about that. You have talked a lot about how we need a sensible approach to the energy transition where we recognize the limitations of some of the cleaner energy sources that governments around the world are wanting to invest in, and then also recognize that fossil fuels aren't going away tomorrow. So talk more about what a sensible transition looks like to you.
To me, a sensible energy transition looks at all energy sources and tries to figure out what is realistic, how can we plan for that, and let me talk about the dumb energy transition to contrast with the sensible energy transition. The dumb energy transition is that if we stop investing in fossil fuels, we will save the environment. The reality is by stopping investing in fossil fuels, you're not impacting demand, you're impacting supply. And frankly, that is the surest way to guarantee higher prices. And the people who can least afford that high price, the poorest, are the ones that are going to gravitate towards policies and politicians who will then remove these restrictions and get them the cheap energy that they want. And so therefore, I think that the sensible energy transition is recognizing that there are billions of people around the world who have very limited energy usage, a fraction of what we use in the developed world. And right now, the biggest driver of demand in the Western world, we're not reducing our energy consumption. We want them to use green energy, but the biggest driver of demand right now in the world for energy demand incrementally is going to be data centers for AI, and data centers for all digital, but digital centers for AI, generative AI. That's going to, double, triple, quadruple demand between now and the end of the decade from these data centers. And plus we have crypto mining. These are all rich world indulgences, if I may call it that. And so a sensible energy transition has to recognize that if we are not able to curtail our energy usage, and there is no way that data centers are only working when the wind blows or the sun shines, right? So they're going to require 24/7 energy, which I, jokingly say is the surest way to make fossil fuels great again, is to do all this, data centers and generative AI. So then the sensible energy transition is, how do we think about minimizing the effect of all the energy usage? Do we need to think about carbon capture? Do we need to think about other ways to manage? Because just banishing investment in fossil fuels is, to me, uh, makes no sense, because all it does is makes the poorest gravitate towards politicians who will remove this restriction on them getting cheap energy.
So let's dive in more into fossil fuels. You had a chart in one of your investor letters that showed sort of the demand for fossil fuels. So it showed liquid fuels, natural gas, and coal, and the demand for all these is growing. So talk about fossil fuels and how they sort of play into your investment approach.
Well, look, fossil fuels are the cheapest source of baseload power, which is power that you can turn on 24/7 without having to rely on uh, any external weather related factors. Nuclear is also part of baseload, uh, and so is hydro. But hydro, rain doesn't fall the same every year. Nuclear takes a long time to build nuclear power plants. So coal and natural gas as energy sources, and oil is more for transportation, although it is used in diesel gen sets as backups even for data centers. But those are the demand for even electric cars. Today, China, 25% of the new cars sold in China are electric cars, and yet China's oil consumption is still growing at 3% per year. In the US, we have 5-6% cars sold, electric cars. Our oil demand is still growing. So the idea that oil demand is going to end anytime soon, oil demand growth, and it's mainly transportation and it's plastics and it's, everything associated with that, that's going to grow for a long time. Natural gas is the natural transition fuel from coal. And, we are the Saudi Arabia of natural gas. Unfortunately, right now, the Biden administration has banned approval of new projects for natural gas, exports, LNG exports. But Qatar and others are developing it. And if I'm a poor country in Asia or in Africa, if I want to reduce my dependence on coal, I need cheap natural gas. And so one of the best ways we can help is do that, is to encourage more natural gas usage, because it's much less CO2 producing than coal is. So I think that, within the fossil fuels, there's a transition. And then the question is, wind and solar, how do we get battery technology so that we can use them round the clock? And they are price competitive right now. They are not, and we're trying for, new battery technology, solid state and others. It's not going to be the same battery that you use in an electric car that would be used for, because electric cars need quick in and out. These, ones need slower in and out from a power storage standpoint for power generation. But the other thing we don't talk about is that if we move to electrification from distributed energy, right? You fill up your car at a gas station. If you move to distributed to centralized energy coming from the grid, you need to upgrade the grid significantly, because you're going to have all these nodes of people who are plugging into the data centers are already causing problems. And now if I have a bunch of Teslas and other electric cars going to charge, the grid is going to not be able to handle the load. And so we're going to need to upgrade the electric grid. We're going to need to invest in more transmission. We're going to need to invest in more local substations. So it's a complicated, we're trying to change what has taken a century to develop. And we're imagining we can do it in 5 years. And I say that's a pipe dream. So sensible, it's going to require a lot of things that have to be put in place. And I think the one thing I would say is we need to think about it patiently and recognize that it's a very complex energy system that has been built over decades, and we can't just put government incentives and suddenly everything will get replaced.
I'm glad you mentioned China there, because, China, like in the 2000 cycle, I'm sure it still plays just a major role in the energy market today. There's one interesting stat I came across with regards to electric vehicles. China has over 20 million electric vehicles. And just for comparison's sake, the US has over 2 million. And there's also debates on, what's going to be happening with China's economy, with, how much debt was required for their growth in recent years. So maybe there's some uncertainty with regards to China and, what their impact will be on the energy markets going forward. How do you think about, China's role in the energy markets today?
Well, China was, the biggest driver of energy incremental demand growth in the 2000s, the entire decade from 2000 to 2020. If I looked at it, China was probably about 40% of world oil demand growth. I don't know if it was all source of energy. It may have been close to that for all source of energy. China is doing a very rapid build out of nuclear capacity. They're doing a much faster build out of, as you mentioned, electrification of cars. Because if China has a weak point strategically, it's that they are deficient in oil and gas. And they get oil through this, through the Middle East, Strait of Hormuz, which if there's ever a conflict for the US, it's very easy for us to choke off their supply. Natural gas comes from Australia, from Middle East, from US. And again, there are ways to control that. So they're trying to, they coal, they have surplus resources of. So there's a new element that's entered, which we don't talk about, which is a strategic dynamic going on right now in the world, where Russia, China, Iran, maybe one block, and, the Western world, Japan, Australia, Europe, US, are arrayed on the other side. And so everybody's thinking about the strategic location of my energy resources. And China has taken an early lead such that today 70% plus of the world's solar modules come from China. Over 70% of the lithium processing that is required for electric cars. So China sells more than half the world's electric cars, but it also sells us a lot of the materials to make the batteries, the lithium and other items. And so it has a chokehold, if you will, on a lot of the green technologies. So one of the big challenges today is, do we want to go from where the US and Europe, US certainly is surplus conventional fossil fuel energy. US is deficient in buying batteries from China. Europe is getting flooded with electric cars from China because they have the cheapest electric cars in the world, because like you mentioned, they have the much larger install base, so they're much early in that. So there's a strategic element that is coming into this whole energy transition discussion, where China is the dominant play in wind, solar, and electric cars. They have 60 to 70% market share for some key technologies there, and we don't. And so, I think the China demand story from an energy demand standpoint is clearly slowing down. China's economy is not growing as fast. China is probably growing demand for energy at 2-3% a year. So that's definitely turned the corner. It's not the engine anymore. India is more important going forward. Southeast Asia, Middle East, Africa are more important. But from a supply standpoint, suddenly turn it on its head. In the 2000s, China was our demand source, and everybody was looking where the supply was going to come from. If you go to green energy, China is a supply source. Are we ready for that? Do we want that? And I think that's part of the energy transition part that is also becoming very important.
When you're looking at oil companies, for example, to invest in, one interesting thing you mentioned on a previous appearance was that, a lot of these companies are going to be reinvesting in new supply. Their stock prices are going to be going down. And when they announce, a dividend increase or buyback, then their stock price goes up. And it leads me to think, is there these management teams that, sort of take a stand and just say, hey, we're going to invest in new production. And, maybe that leads to lower share prices and maybe makes buybacks even more opportunistic at some points in time. How do you think about this when you're investing in this space?
Well, I don't believe that this cycle is going to see the same supply response that prior cycles saw. I gave you the example of offshore rigs. We've seen it even in a much lower cost of barrier to entry offshore supply boats, which is a very niche market, but nobody wants to invest in a new 20-year asset. So on the oil supply side, the easiest place to invest with a quick payback was shale. And that would still be happening. Yes, they've been disciplined for a while, but if they were to break discipline right now, here's the problem they're running into. No tree ever grows to the sky, and neither does any oil producing region, right? So we've had the West Texas, where some of the earliest oil exploration in the US happened. We've been through two major cycles. This is a third major cycle. And the shale tree has grown much further than any of us foresaw 5, 6, 7, 8, 10 years ago. It has gone much further. But what we are now seeing is that companies are saying, I have a 10-year or 12-year or 15-year inventory remaining at my current pace of my life of my current fields. And, it's not like I have more to find. And if I keep drilling these acreage, I'll run out of drilling in 12, 15 years. Once a company gets below 10 years of remaining inventory, its multiple goes down. So I can increase my cash flow, but I can drill more. I will drill my remaining acreage faster, but then I'll have less number of years of drilling inventory left, which means my multiple goes up for higher cash flow short term, but my multiple comes down for shorter kind of reserve life. So we are running into this problem that shale is running out of new fields to find. I can keep drilling on my existing acreage. I've got thousands of acres I can keep drilling. But beyond that, there is no new discoveries taking place that, I found a new Permian, I found a new whatever. So that's why I believe that between the not wanting to invest in new long-term projects and shale running out of massive new finds, we are in a supply-constrained cycle. And unless something comes along that shocks us meaningfully, I think this cycle is going to be one where demand continues to grow slowly and supply remains constrained for both ESG and, in the case of shale, kind of geological factors, if I may call it that.
You also touched on AI and the data centers and their impact on energy demands. Sam Altman recently commented that he believes that a lot of people are underestimating the energy demands of this technologies. How big of an impact is this on the energy thesis overall? And maybe talk about, how significant, this increasing demand is going to be.
Well, today, data centers plus crypto mining, which is, I guess you could call it kind of a data center. It's all computers in a location doing mining for cryptocurrencies. If you take those combined, I think they're about 2% of world electricity demand today. There are IEA, International Energy Agency, and others have estimated that that'll double to 4% of world's energy demand by 2026. And again, double from there by 2030 to 8% of world's electricity demand. So it's quadrupling. The rest of the electricity demand is not growing. Now, if you on top of that throw electrification of cars, it really does put an unprecedented demand for electricity. Electricity demand historically around the world, in 2019, the International Energy Agency estimated that energy demand with electrification was going to grow at 1.9%. If you look back the prior decade, global electricity demand was growing at 1.5% to 2%. And suddenly we have these new sources which are driving 3.5%. That may seem not much, but at the margin, it's a lot. And so I think that data centers and our insatiable need for, everything digital, we want virtual headsets, we want, AI, we want generative AI. A Google search versus going to generative AI, ChatGPT to do the same search. Google search is 1/9 to 1/10 as much data intensive, compute power intensive as using. And now today, a few of us have discovered generative AI, and we, do it without thinking, and more people are going to adopt it, and more users are going to come up, and it's just going to, so far the demand estimates that people have made have proved to be too low. Let's see if these demand estimates prove to be too high. I doubt it. I think, there's a lot coming in AI, and if all the dreams come to be true, then energy demand is going to be, one of the main constraints. I think more and more people are recognizing that energy demand could be one of the biggest constraints. So yes, let me add that the NVIDIA and others are trying to improve chip efficiency for power consumption. There's a lot of, about 40% of a data center's demand goes for cooling, air conditioners. They're trying to come up with new ways to cool and whatever. So these estimates that I just told you of IEAs are assuming efficiencies take place. So it's a constant battle. The actual demand is much higher, but with efficiencies, the energy demand hopefully only grows by, 25% a year and not more than that.
I think it's also interesting how you mentioned China played a major role in the decade of the 2000s. And then now you look at India, one of the biggest countries in the world, one of the fastest growing economies in the world. And you'd imagine that, the energy demands over the next decade from India is just going to be massive as well. I was curious if you could speak more to that.
Absolutely. Well, I spent a fair amount of time. I have a, small India fund I've been investing for a while. But what we've been looking at in India is that steel demand is starting to grow at double digits. So the infrastructure build out is happening. If you look at what happened in China 20 years ago, beginning of the 2000s, that, you start to see steel demand is growing at double digits. Cement demand is growing at high single digits. And along with that, energy demand is right now only growing at maybe 5%. But my sense is that, if as the infrastructure build out happens, you're going to see other parts of the cycle, trucking, autos, everything that'll start to also accelerate. And it's as you move up the, per capita GDP curve, all of these things, as we saw in China, tend to have an accelerant effect as you build out infrastructure. More people, already, I think, demand from air travel is growing also at double digits levels. So there's a lot of elements of demand where, India will never be as energy kind of hungry as China. China overbuilt its real estate, overbuilt its infrastructure. India will always be 2 steps behind the curve, but it's still on a path where I think that for the rest of this decade, it's going to be the biggest factor in terms of incremental demand for a lot of free, energy and related resources.
A lot of people, when I think about the energy space, a lot of people like to think about oil and gas due to the underinvestment issues that you've highlighted, but you're also looking to capitalize on the underlying metals that are needed for the transition to sustainable energy. Maybe you could speak more to that, what the primary metals that are needed in this transition and what metals you think show a lot of promise from an investment perspective.
Well, so, I have a chart that I use, which is, borrowed from a McKinsey report, which talks about which metals are needed across the entire, energy transition. And if you start with, wind towers and you look at solar and you look at hydrogen plants and you look at, biofuels and you look at all of these, the number one metals needed across all of them is steel. So, steel is an intermediate material. For steel, we need metallurgical coal, which again is a 4-letter word, but India, if it needs more energy, that's going to require more metallurgical coal, and there's not enough drilling happening, enough exploration happening for metallurgical coal. But the second most important metal, which is needed in everything electrification, if you need to carry electricity from point A to point B in your car, inside a wind, from wind project or from a solar panels, requires a lot of copper, or batteries of any sort, copper. And again, the amount of copper that people have estimated for energy transition over the next 20 years we need is more copper than we found in human history. And yet, if you look at copper grades, they're falling. And then if we want a green baseload power source, the only green baseload power source is nuclear. And people are talking about building small modular reactors, which will be quicker, cheaper. Initial ones will take 6-7 years, but once we get them building, then we can build them in factories, bring them on site, and put them together much quicker. And SMRs is not a revolutionary new technology. There are hundreds of small modular reactors on nuclear submarines, on some aircraft carriers that already exist. Those are small modular reactors, and they've never had a nuclear meltdown in a submarine or an aircraft carrier. So, using that technology. So again, that'll take a while, but nuclear, China's building out in a big way, India in a slightly smaller way, but I think the West is starting to recognize that that's, in fact, at COP28 last December, US, Europe, and Japan announced that they're going to triple their nuclear capacity by 2040 to meet the green energy targets. Nobody talked about where's the uranium going to come from. So it's going to require a lot of exploration for uranium. So, these are things that we look at, and we look at all the energy sources, whether it's thermal coal or it's metallurgical coal for making steel, which is needed for energy transition, or it's copper, without which, many of these transition technologies don't happen, or it is going to be anything related to nuclear. And I think that all of those create opportunities. And again, we think of energy as a continuum that doesn't stop just at oil and gas. And that's where I think a lot of people just limit themselves to that. We think of this energy transition as having all these interconnectedness, and therefore that creates opportunities.
Mm-hmm. Hey guys, it's Clay Fink here, host of We Study Billionaires. Today, I wanted to tell you about our show sponsor, Vacasa. The dream of owning a vacation home can be daunting. From finding the best guests, to the maintenance, to organizing the cleaners after every guest stay. With Vacasa, they make that dream into a reality. As a full-service vacation home management company with vacation homes in key destinations across the US, they know how to make owning a vacation home easy and profitable. On top of proactive property maintenance visits by professional local teams, a data-driven booking platform, and around-the-clock support, homeowners earn on average 20% more revenue from their vacation homes. Vacasa makes vacation home ownership easy. If you're looking to make more from your vacation homes by doing less, partner with Vacasa at vacasa.com. That's vacasa.com. In nuclear, I find nuclear quite interesting because, you only have a certain number of options when it comes to the base load power source, because when it comes to solar and wind, the wind isn't always blowing and the sun isn't always out, and, demand fluctuates throughout the day. So maybe you could speak more to nuclear and why you believe it makes so much sense for these governments to invest in it, due to these reasons related to the base load.
Yeah, well, the first thing I should say is, if we are interested in green energy, the lowest generation of CO2 per unit of power produced, lower than wind, lower than solar, is nuclear. And yes, we have a nuclear waste that we have to deal with, but the nuclear waste is a small amount. I mean, it's not that large, but there are two big concerns about nuclear. One is the waste, what will we do with it? And the second is the safety if you have a meltdown. So these SMRs are actually, there's technologies where we make them safe in terms of much safer in terms of not having the meltdown, kind of risk. And the nuclear waste is something that we'll have to come up with a solution, but burying it deep underground, or, putting it into space or in the bottom of an ocean, there are many solutions. But if we are there is no Pareto efficient frontier where we can go to green technologies. And, there's going to be all these batteries to dispose of after these electric cars have run their course. There's going to be all this old solar modules to dispose of, all these old wind turbines to dispose of. Everything, there is no, we just, stand in the sun and the energy comes to us. There is no pure green. So each one has its own, side effects, if you will. And nuclear has its own, but I think those are very manageable, and nuclear remains a green energy source. And I believe with these small modular reactors, we have a real room for it. The holy grail, to be clear, people talk about it, and I've done some work looking at it, is nuclear fusion. Nuclear fusion, there is no waste and it's perennial energy. But people keep talking about nuclear fusion, as yet we haven't yet solved the technical problems. But if we ever got it, which could be by 2035, 2040, then all of our problems would go away and we could have perennial energy from nuclear fusion. But, I'm not holding my breath on that in my investment time horizon. So, keep an eye on it for the future of humanity. It could be the panacea, but it's a long time away.
In uranium, the uranium price has had a pretty good run up in 2023. You had one of the bigger producers announce that it's looking like they were going to fall short on production. And then your letter also highlighted a bill that passed in the House that would effectively ban uranium imports from Russia beginning in 2028. How do you see the market developing from here in light of that recent run up?
Well, I think, there's a lot of political challenges. 40% of the world's uranium comes from Kazakhstan. Much of that transits through Russia. Russia processes about 25, after you produce the uranium, you take it to a processing facility where it's processed so that it can be then converted into a material that can be then used in to build the rods that go into nuclear reactors. So there are multiple stages. About 25% of the West's processed uranium is in Russia. So we're trying to reduce our reliance on Russian oil, Russian gas, Russian, the metals. We just came out with a rule a couple of weeks ago that they can't supply their metals into COMEX or into LME. And so the one remaining area where Russia is still supplying the West is a significant portion of our uranium, process supply. And I think that the big challenge for everybody is how do we wean ourselves off the Russian supply? And it's a dirty little secret that Washington doesn't want to touch it with a barge pole, but there are moves afoot now to give some time till 28 for Western development of processing capability and more mine capability to reduce, find routes from Kazakhstan via a different route than through Russia. There are challenges, but we're trying to, I think the government or the politicians are trying to give time to adapt that. But that remains a risk. I mean, I'll give you one example. 5% of world's uranium supply comes from a tiny little country in West Africa called Niger. Niger, Niger as it's pronounced. And they just kicked out the French. They're telling the US to remove its base, and the Russians are taking over. And the Russians are now in charge. And so there's that mine is no longer supplying. It's probably going to be redirected to supply to China, whatever. It's going to create challenges for the West. So there are challenges around the world in nuclear supply, in uranium supply. We want green energy, but we have to find more friendly sources, and that's a big challenge.
I was also curious. I know some investors to get exposure to uranium, a lot of them, I think, just purchase a Sprott uranium trust that just holds the uranium itself, and I'm sure others invest in miners. How do you think about getting allocation to that sector?
I think that investors are getting exposure through either, like you said, Sprott, but Sprott, used to trade parity or slightly above. Now it trades at 5 to 10, 11% premium. There's another one, Yellowcake, listed in London, which trades at a 10 to 15% premium. So those have kind of lost their luster a little bit. And what people are now finding is more interest in, buying some of the miners, especially some of the development miners. So one of the ones in Paladin in Australia has a mine in Namibia that had been shut down for 7 or 8 years. The company had gone through bankruptcy. It was producing, earlier, 7, 8 years ago. And now it's restarting, and it's just restarted. And they just put out a release that they've started to, first production has just, gone through the process, through the mill. And that's been a great performer. But there are other companies, Cameco is a big one in Canada that produces uranium. Kazatomprom, which is the one that produces 40% of the world's uranium that comes from Kazakhstan, is kind of, there's a lot of political risk involved with that. There are other smaller development companies in Canada and US. And so we look at a basket of all of these, and these have all, benefited from this in addition to Sprott. And so, I'm not recommending any one name because these are all small illiquid names, but I'm just pointing out that in uranium, other than Cameco, which is a large cap liquid company, you have to dig deep to understand what are the other options, and none of those options are particularly large or liquid, but each one has some characteristics of mines that are under development or most of them are development stories, not currently producing, because the big two producers right now are Cameco and Kazatomprom, and there are not many other public options available.
Mm-hmm. I mentioned earlier, I found it so interesting how you have investments in all these different types of sectors. I was curious to get your take on if there's any sector or area that really just kind of shines relative to the others in terms of conviction and the opportunities you're seeing. Yeah, what's your take on that? Is there one or two sectors where you think there's just really, really good opportunities there, or you just think, overall, a diversified approach and just sort of investing with these broader themes is the way you're thinking about it?
Well, I'm not putting all my eggs in one basket. I love uranium, but I have, a portion there. I love offshore related companies. So, everything from a supply boat company to offshore drillers to one company that does kind of offshore construction support services, equipment and services. I like the idea that this is a sector where if there's majors that are spending money, that's where most of the opportunities that they're seeing for, meaningful difference. And there is no new supply coming on. I have high conviction that the supply side is structurally constrained because nobody's going to build new assets. So I love areas where I can stop worrying about supply. In cyclical industries, you almost never get that. Here, I can almost stop worrying about supply, and I just have to worry about the demand. And the demand, as long as it's even moderately growing, things are going to be in great shape. And so that's an area that I love for the fact that there is no supply growth. In uranium, I like the fact that it's going to take 4, 5, 6 years to develop new uranium mines if the demand is there. So, you again, we talked about this at the beginning about cyclical industries. Cyclical industries, I want to understand what the demand is doing and how quickly can supply screw it up. And when I see sectors where supply can't screw it up, and metallurgical coal is an area where India is going to need more steel, Southeast Asia is going to need more steel, and we can't do our green stuff without steel. And most of these developing markets don't have a large amount of scrap steel to run electric arc furnaces like we can, so they have to use iron ore and met coal, and yet coal is a 4-letter word, nobody's investing. And so we think of metallurgical coal as another area that's interesting. So these are some of the areas where I see supply either not happening or going to take a long time to happen, and demand has a good trajectory where I don't see how we suddenly stop using steel or we don't go down the nuclear path, or the offshore drilling suddenly dries up. These are areas that I find great opportunities. But again, I'm not putting my eggs all in one basket. Tomorrow, if another Fukushima happens, right? I mean, I hope not, but that's a risk, right? So let's put the risks on the table. If Fukushima happens, something happens. I don't think there's the steel bridge collapsing in Baltimore means more demand for steel. So I'm not worried on the steel side. India's not going to suddenly say, oh, let's go back to living in huts. We don't need that infrastructure. That's not going to happen. In nuclear, you do have a risk. In the rest of it, you don't have that risk.
So coal is typically thought of as a very dirty energy source. And you mentioned met coal there. I was curious if you could just describe what met coal is and how it sort of plays into your thesis here.
So coal comes when you dig coal from the ground. You don't know before you dig what type of coal you'll get. So you have the calorific value and the ash content and the sulfur content of all different coals from different coal mines differ. And the lowest grade, coal is used in power plants, and you have very low grade coal. Then you have high ash content coal that comes from Indonesia, India, other places that is also used for power generation. And then you have the highest grade coal, which is called metallurgical or coking coal, and that is put in a coke furnace to produce coke, and that coke is then put in a blast furnace along with iron ore, and that coke provides the heat and the sealing properties and the to be able to take that iron ore and melt it and produce steel slag. So that metallurgical coal is the highest quality, if you might, I might call it that, calorific value coal, and that is found in rare places. It's found in parts of the U.S., some of the coal mines. It's found in Australia. It's found in Mongolia, and very few other places do you find smatterings of that high quality coal. And the largest producer of met coal in the world, BHP, has been running down its production, and of Western metallurgical coal. The second largest producer, Teck out of Canada, is selling its met coal mine to. It's getting out to get more green. It's selling its met coal mines to Glencore, and the third large Western producer, Anglo American, is also running down its met coal mines. So yes, Mongolia has grown its met coal production, but the U.S. and Australia, rest of it is not growing. So there is one new coal mine coming on in Alabama, which I visited a few weeks ago, and was very interested to see that, because the world, is not doing that, luckily, but that one will be golden because it's the only new one coming on in the next few years, and they're going to, I think, be very well positioned. But the reality is that this is a key commodity without which you make steel two major ways. You make steel in a electric arc furnace, where you use electric arc with cheap electricity, and use scrap steel. And we have a lot of scrap steel because, we are a developed economy for a long time. We have a lot of scrap. In a developing economy where you have small infrastructure build and you're building out much more, you don't have enough scrap steel to be able to provide enough steel for your growth. So you go for the blast furnace route. And that's what we're seeing in India, Southeast Asia, and, probably in the future in Africa. So that's why I like met coal.
So in light of all this talk on the energy transition, I'm curious to get what are some of the most important or most interesting data points you're going to be watching over the next year that are really going to move the needle on what you're invested in?
Well, I mean, I think the data points come at us, every week, every month, every year, and then with greater. But the one interesting data point that's been coming at us recently, in addition to the data centers, is the move away from electric cars to hybrids. It's a very interesting point that even in China, which has been a very fast adopter of electric cars, you're now seeing more hybrid growth than you're seeing what we call BEV, battery electric vehicles, pure electric. And, Elon Musk was complaining about it, but the reality is that consumers prefer the fuel efficiency of a hybrid, but the range anxiety removal of a hybrid, right? So that's why I think that, again, from a, oil demand, for those who were riding the epitaph of oil demand, that's a very interesting data point that is coming to fore. The other interesting data point is China has been a major headwind on metals demand. And looking at China, we're trying to see the housing market. It was the mother of all bubbles. That mother of all bubbles has blown up, where people own 5, 6 houses, and that was a form of investment. And there's so many empty houses, and there's so much oversupply that housing starts have fallen by 30 to 40% for 3 years in a row. Our 2008, 2009 looked like a pipsqueak compared to what is going on in China right now. That's a major headwind for all metals. China's built a lot of steel capacity for this. They're exporting that steel, but everybody is not putting up tariffs, so they're going to have to shut down that steel capacity because nobody wants to shut down their own steel industry. So, watching China data to see when things stabilize. China is still the second largest economy in the world, and it is the number one consumer. It's the second largest consumer of oil. It's the number one consumer of steel, iron ore, seaborne iron ore. It's the number one consumer of coal, even though it's self-sufficient. It's the number one consumer of copper. It's the number one consumer of aluminum. So there's a lot of things in which we have to watch what's going on with China just to see it's not completely blowing up. And then, the U.S. recession, U.S. demand. Europe has been in a doldrum for a couple of years. Is that coming back? So the macroeconomic factors. And then, on the supply side, we look at all the supply data points on oil, on gas, on uranium, whether the Kazakhs are going to continue to disappoint. So, each one has its own little sub-sector that we watch. So it's not one big data point, but there are some important ones.
Absolutely. And when I think back to what sort of happened after the GFC, the rise in shale production, I think sort of it seemed like it took a lot of people by surprise and, led to that down cycle being much longer than many might have anticipated. With that in mind, is there any breakthrough technologies that, might sort of blindside investors in this cycle? Or what sort of things, might lead investors to maybe be too optimistic on energy today with regards to like a breakthrough type technology?
I mean, there's always a risk. I mean, I couldn't have answered this question with any intelligent answer back in 2007, 8 in terms of shale. I had no idea that was coming. So when I think about it, there are always going to be surprises, and I think the reality is that battery technology is a chemistry problem. It is not a Moore's law problem, right? It's more akin to Murphy's law than Moore's law in terms of fixing some of these challenges with the supply chains. But if there is any breakthrough in a new type of sodium battery or molten salt battery, there's been many discussions. Sulfur batteries, something that allows for much cheaper storage of power from wind and solar, and that makes them much more competitive with natural gas, with coal, with other sources, and suddenly we can do a lot more. The reality is we'll have to come back to the point that people are now putting tariffs on import of solar modules from China. So it's not just a one-directional thing, right? We also have the strategic element that yes, we can get a lot of cheap solar, but if we want to increase our reliance on China, but a breakthrough in batteries would be a very important element of that surprise. And the other more pie in the sky, but much more fundamental, in my opinion, long term, is something like nuclear fusion, which I talked about earlier. Something like that would be. So I think those would be the two biggest. From a finding copper, there are some technologies that might help us do a better job at finding and refining copper. But I don't see those as breakthrough. Maybe we'll find a lot more than we have found recently, and we'll be able to meet the challenges. But it's still going to take a while. On oil and gas, I don't see anything, but I didn't see shale. So take my word for what it's worth. I was clueless about shale in 2007, so I may be clueless about the next technology coming along. But when it does, hopefully, remember, shale didn't happen on day one. It took from 2010 when we started shale oil drilling till 2014 when we had the oh shucks moment where oil prices fell apart. So it's not like any new breakthrough produces energy like this. It'll take a couple of years, but being early on seeing that is going to be important.
Wonderful. Well, thank you so much, Arvind. This was great. So many interesting things to think about and consider here, and really appreciate you joining me on the show. Before I let you go, how about you give a handoff to the audience to how they can learn more about you, Geosphere Capital, and anything else you'd like to share?
Sure. Thank you, Clay. Thank you for the interview. I really enjoyed the conversation. And for investors who want to learn more, they can visit our website at geospherecap.com. We are a hedge fund, so we can only take qualified investors. But on geospherecap.com, we do have links to some of the other kind of pieces we've been involved with in terms of podcasts and publications for people who want to look at that. But if they need to and are interested in learning more about Geosphere and investing with Geosphere, they should reach out to ir@geospherecap.com or evan@geospherecap.com. But we are not allowed to advertise, and we don't advertise. We just if somebody's interested, they'd still have to be qualified. Thank you.
Great. Thank you, Arvind. I'll be sure to get that linked in the show notes.
When they did that financial repression playbook of, hold rates, basically let inflation run hot compared to interest rates, eventually people want out. There's that IMF paper by Carmen Reinhardt. I think she phrased it like you need a captive audience, right? If you're going to inflate the debt away, you got to keep people in the debt. And if your money is going to lose value, how do you keep people in the money?